right, welcome back, everyone. For those of you still out having some coffee, please join us when you're able. My name is Mark Wolter. I'm the Executive Director of the International Law Institute in Washington, D.C. I am newly installed, so I'm just getting to know my way around. I've been here before, and so very happy to be back again. Before I let everyone speak, I think I'll introduce everybody first, just very briefly. That way we can just go through everything. To my right is, of course, Marek Dubovec. He, like Madonna and Prince, seems to need no last name in this forum. So I think, but the only thing I will say is that I'm very proud to have him as my new colleague. He is at ILI, Director of Development Programming, and so really happy to be on board with him. Online, I believe we have Giuliano Castellano, and who is an associate professor of law at the University of Hong Kong, where he teaches and researches in financial law, financial markets, and regulation. And he's been a regular consultant for IFC, as well as a delegate for Italy to UNCITRAL for Working Group 6. And then finally, Avery Belka. He's the Vice President and Deputy General Counsel at the U.S. Federal Reserve Bank in San Francisco. And we're very happy to have all three of these panelists here with us to discuss coordinating secured transactions reforms with regulatory agencies. And I'll ask, we'll just stick to the panel schedule, and I'll ask Giuliano to give us a brief overview of his thoughts on this subject.
Thank you very much, and I'm very glad to join this panel. I'm very happy to actually connect and see many faces, although virtually. I guess actually the idea is that I would start with a brief introduction of the regulatory issues that are relevant for coordination with secure transaction law. And then, however, I think actually Avery will move on some others, but I'm happy to proceed in a different way. Can you hear me? The chair? Shall I?
Yeah, I'm going to hand it over to Marek.
Okay. Yeah, thanks, Giuliano. I thought that you being in a different time zone and Avery, I would give a brief summary of some of the regulatory aspects that have been mentioned throughout the conference, and then you can pick it up and address some specific issues, and then Avery can also address some specific issues. So if you indulge me, regulation has been mentioned several times throughout the program, whether in the context of international instruments, such as the guide on access to credit that UNCITRAL is developing, and there are certain sections on prudential regulation, but also licensing of financial institutions. It's an evolving text, and as you know, we have provided some input directly to the Secretariat as to how to treat those types of issues. We had heard yesterday about a project on digital assets. It's called Private Law and Digital Assets, and I'm part of the drafting committee of that project. But the document itself also refers to regulation, and there are actually certain aspects that the working group recommends the regulation addresses, so as to provide a predictable framework for transactions, commercial transactions with digital assets, not limited to secure transactions, but also custody. Today, on the earlier panel I spoke at on agricultural finance, there were certain references to regulatory bodies that are being formed, such as warehouse receipts councils and other protection mechanisms, such as guarantee funds that assist or that bridge or create the trust in the system for the users. And we also heard about we heard some references to state guarantees and as to how they affect lending, which is again a type of a regulatory intervention. And I would conclude my summary with what Milot said on an earlier panel, that you need three parties to a transaction. You need the parties to a deal, and you need a regulator to be on board. So as you can see, regulation has been interwoven with these private law and commercial law issues throughout different types of panels. So with that background, Giuliano, I'll turn it over to you. Thank you.
Thank you very much. We've been coordinating with many emails, and thank you very much. So yes, the idea is that there is a general trend, first of all, a shift in what is the normal perspective. Let's say we can see that for many years, we've been focusing primarily on reforming the private law aspects, and that's absolutely essential. Ultimately, is the building block and the main role of the organizations such as UNIDROIT, UNCITRAL, and also has been the primary point in the agenda of multilateral organizations. So yet, I think probably COVID-19, but even a bit before that with the global financial crisis, have highlighted the need to have a sound, let's say, not overbearing, proportionate regulatory framework that essentially does two things. Number one, it establishes what are the perimeters, essentially within which different credit products, in particular, any form of access to finance is developed. And number two, gives credibility to any form of effort. We can say that there is also a third aspect in a sense that together with credibility, it also allows sometimes the regulatory framework to jumpstart what are the different private law reforms. Allow me to give you some example to substantiate what I just noted. Well, first of all, when it comes to, for instance, the policy that are devoted to promote different products, such as receivable financing and in particular factoring, well, the ask for this reform comes precisely from the regulator. So the main demand comes from regulatory agencies, which can be central banks or can be other form of regulators, such as non-banking supervisors. So the first ask comes from them, that the primary client, if we will, if we look at it in this regard, are actually the regulators. And this is because these products in most of the countries are considered as regulated activities. And in those countries where are not considered as regulated activities, we start to see some issues. The issues are primarily related to the fact that whenever an entity is licensed to develop and to implement and to offer to the public certain kind of products, such as receivable financing, factoring, and all the related products, well, ultimately, they can benefit from a larger pool of liquidity. And we know that only that, for instance, banks or other institutional investors can only invest in regulated financial institutions. Therefore, rendering let's say, a factoring company a licensed institution will allow that company to access more easily to bank capital. And therefore, ultimately the customers and the people of the given jurisdiction will benefit. The second push, always coming from, let's say, from bottom up rather than top down, is precisely from the industry. And we can note that, for instance, in a number of jurisdictions, and including actually more developed economies such as Hong Kong or Singapore, the industry is asking for a license. And is asking for a license in different aspects, both for instance, receivable trading platforms, but also, for instance, for activities related to digital assets. And as an example, for instance, in Hong Kong, the securities license has been extended with some exceptions, also in dealing with digital assets with some specific rules. And again, this is a request that comes from the industry because, as I was saying, this will allow to unlock larger capital, more liquidity, and ultimately create a validation mechanism that ultimately the company is genuinely and solidly run. So, unfortunately, however, as we know, as we have been seeing, and I think Milot can also comment profusely on that, and of course, the other panelists have much more experience than me in this. But we can actually see that sometimes the coordination is not easy, in a sense that, for instance, when we're talking about different definitions of what is factoring and what is a digital asset even, well, we might have a misalignment between what is the private law definition, what is needed for private law purposes, and what is needed for regulatory purposes. Again, allow me to give you a very brief example. There are situations, for instance, in which that the focus of the authority, of the regulator, of the supervisor, is not so much the transaction per se. In fact, the transfer of receivable, for instance, or the holding of digital asset largely intended, like, Ireland's miles, is ultimately not a regulated activity per se. What is regulated instead is the business of offering to the public this form of financing or this form of assets. And then again, it depends what kind of digital assets we're talking about, because of course, there are some distinctions. So in this regard, we can already appreciate while private law is looking at the transaction and therefore is rightfully so concerned about different elements of parties, the third party, as it was correctly said earlier, might perceive the entire transaction in a completely different way. Again, is a problem if we don't address it, it has a solution if we do, in a sense that coordination between the different definition can be provided and can actually complement without impacting negatively, for instance, on the definition provided from the private law framework, and the other way around. So when we are looking at these interplay, we actually understand a bit better why the regulatory function can actually validate also the private law reforms. Because ultimately, if the regulators are going to consider as a regulated activity, for instance, a factoring company, well, then this will imply they will have to have a coordinated definition of the license with the factoring contracts or, the different elements. And therefore, the rule will become effective. Again, another example to give you a sense of the importance. So in some jurisdictions, for instance, where we see that there has been a number of reforms, I'm thinking about right now Latin America, the Caribbean as well, without pointing at any jurisdiction specifically. But we can see that after secure transaction law reform has been implemented based on UNCITRAL model law, or, primarily actually, yes, UNCITRAL model law, well, the banking institutions might have to comply still with reporting standards that were established before the reform occurred. So that means that in some cases, we do have effectively that internal compliance mechanism of the bank are still following a process whereby the reform, the registry, maybe has not been implemented. So we have seen, for instance, in some banks of some jurisdictions, that actually they were still reporting to the regulators, not so much the search on the registry, but actually the stamp duties and whatever was before. This creates, again, a very strong mismatch because it renders ineffective a reform that has been implemented afterwards. So Other examples are, of course, for instance, the treatment, the prudential treatment of factoring. And there again, we do have a variety of instruments, a variety of ways. Also, in this case, we don't want necessarily to implement what is, for instance, the banking regulation or prudential regulation for banks if the factoring company is not taking deposits. But again, some sort of minimal capital requirements might be necessary precisely to ensure the soundness and precisely to inject confidence in the regulatory system. So I would say that to conclude, then maybe I'm happy to actually to take more time if needed and actually elaborate on any further aspects. But I will say that the shift in regulation, the shift in, to be more precise, in law reforms that has been occurred, and with a growing focus on regulation and public, let's say, initiatives like the one Marek was mentioning with the guarantees and so on and so forth, it comes as a bottom-up necessity, but is also an advantage, is also a positive development that it helps to validate and it helps to ultimately provide a cohesive legal and regulatory framework for these transactions. And how to do that? Well, depends on where we are operating, but certainly the coordination with regulatory agencies, the coordination with these other counterparty, as it was fittingly defined earlier, is actually is essential. Also because in some cases, the regulators might not have the proficiency in private law matters that actually, for instance, the distinguished panelist and participant and audience of this conference do have, except for me, of course. So in that regard, there will be an extremely useful exercise already to present these form of products and the different prudential elements. I will stop here because I don't want to take too much time from my other panelists, but I'm happy to elaborate further on any points.
Thank you very much, Giuliano. I hope you'll stay with us for some questions following presentations. Marek, would you care to follow up?
Sure. Just very briefly to follow on Giuliano's explanations concerning and focus primarily on factoring. The fact is that we see and we draft commercial laws that include some regulation that is embedded in commercial law, which probably wasn't the case a decade ago or so. These commercial laws may contain a single article that delegates some regulatory powers to some agency. That is, for instance, the case of a leasing law in UAE, which could not be implemented because the central bank was surprised that it was tasked with regulating leasing. Or there may be more elaborate, such as the laws that we're drafting with the EBRD and the MILOT's supervision on factoring, where actually the details of licensing and related matters are spelled out in the factoring law itself, so that we actually give some clarity to the regulatory agencies as to how to license factoring activities, as Giuliano called them. Two remarks concerning some other assets, particularly, and concerning the project at Unidroit on warehouse receipts and digital assets, which will then take us to Avery's presentation, focused primarily on digital assets. Obviously, the warehouse receipts regulation is slightly different. So a warehouse receipts law, such as the one in the Philippines or Kenya, actually includes a lot of regulatory measures that establish a warehouse receipts council and the licensing and supervision of warehouses. So that's another example where regulatory elements are being included in commercial laws. And one of the reasons for it is that on the back end of these transactions, there are secondary markets where these assets are now traded. So there are platforms and exchanges for receivables as well as electronic warehouse receipts, which inevitably attract the attention of a financial regulator, typically a Securities Exchange Commission, that sees now these assets more as securities and wants to assert its authority. So it's it's not only on the front end, as Giuliano was explaining, the licensing to engage in the activity and to issue, but also concerning warehouse receipts specifically, as well as receivables in the forms of some tradable assets. There is also another layer of regulation, which also applies to digital assets. As we know, that has been somewhat of an area that falls under the regulatory agencies that oversee securities. Thank you.
Thank you very much, Marek. I will move on to Avery now. If you're online and available, we'd like to hear from you.
Great. Hello, can everyone hear me?
Yes, I think we can all hear you.
Great. Thank you very much. It's a privilege and honor to be addressing the conference today. I'm going to provide a very high-level overview of the supervisory and regulatory developments regarding crypto or digital assets and highlight some implications with respect to private law. When I refer to crypto or digital assets, I'm referring to digital assets that are based on cryptography, excluding central bank digital currencies. And before I begin, I must provide an obligatory disclaimer that my comments today reflect my personal views and do not represent the views and opinions of the Federal Reserve. To generalize or oversimplify, the focus of prudential and supervisory work regarding crypto assets is focused on two areas: prudential safety and soundness concerns, such as financial risk, capital, liquidity, operational risk, as well as consumer protection, anti-money laundering, and legal rights and remedies. And the second area of focus is the legal permissibility of crypto asset activities. In the US and many other jurisdictions, the prudential and regulatory framework to address crypto assets is largely the same framework that existed before the creation and expansion of digital assets, but this is changing. There are important private law implications for each area of supervisory focus. Private law provides an important legal framework for the assets and activities by addressing the rights, obligations, duties, and remedies, all of which have implications for prudential safety and soundness concerns. Private law also helps inform the characterization of the crypto assets and activity, which helps inform whether they are permissible. This is important because banks and financial institutions, unlike ordinary companies, are generally permitted to only engage in banking and financial activities. The international regulatory work has been led by the Basel Committee on Banking Supervision, or the BCBS. The BCBS is the primary global standards setter for the prudential regulation of banks and provides a forum for regular cooperation on bank supervisory matters. Its membership is comprised of central banks and bank supervisors from 28 jurisdictions. The BCBS has published a series of papers and consultative documents on the prudential treatment of crypto asset exposures. It has identified three principles for the design of a prudential framework for crypto assets. The first principle being the same risk, the same activity, the same treatment. And what this means is that crypto assets and traditional assets with similar risk and economic function should be treated similarly. The second principle is simplicity. The design of a prudential framework should be simple and flexible to address the pace of change and the potential for crypto assets to become systemically important. The third principle is minimum standards. The BCBS standards would be minimum standards, and jurisdictions may adopt more rigorous standards. The BCBS categorizes crypto assets into two categories, which each having their own treatment for prudential considerations such as capital and liquidity requirements. Group 1 consists of tokenized traditional assets such as bonds, loans, deposits, equities, commodities, cash in custody, and stablecoins. Group 2 includes all other crypto assets, excluding CBDC. Group 2 assets are considered riskier and would have more rigorous prudential requirements. The classification of the crypto assets is dependent upon private law. To be eligible for Group 1, crypto assets must pose the same level of market and credit risk as the physical asset and must confirm the same level of rights as ownership of these assets in traditional form, such as rights to cash flow and claims in insolvency. There must be no feature of the crypto asset that could prevent obligations from being paid in full when due, similarly to the traditional asset. And this would apply to all bonds, loans, deposits, commodities, etc. For stable coins, they must be redeemable in fiat currency, and there must be sufficient information to verify the ownership rights and the reserves backing the stable coin, of the reserve backing the stable coin. I'd next like to turn to some domestic US developments. In the US, the federal banking agencies have been developing a crypto asset roadmap. And this roadmap is focused on assessing key prudential safety and soundness risks, legal permissibility, and analyzing the applicability of existing regulations and guidance. This work has focused on specific digital asset activities, and these activities are crypto asset safekeeping and traditional custody services, such as facilitating crypto or fiat exchange, transaction settlement, trade execution, record keeping, valuation, tax services, and reporting. Ancillary custody services, which include staking, lending, digital ledger technology, distributed ledger technology, and governance, and the facilitation of customer purchases and sales, accepting as collateral for loans, and the issuance and distribution of stable coins, as well as holding crypto assets on the balance sheet. I would next like to turn to the implications for central banks as service providers or banks to banks. In the US, there's been a recent uptick in novel bank charters being authorized that permit institutions to engage in a wider range of new activities, including digital asset activities. For example, there have been limited purpose banks that accept uninsured deposits, hold crypto assets, but don't make loans. These non-traditional institutions are increasingly requesting access to reserve bank services, including master accounts, to support the introduction of new financial products and delivery mechanisms for traditional banking services. To address this development, in August 15th of 2022, the Federal Reserve finalized guidance that the reserve banks will use to evaluate requests for accounts and services. The guidelines are intended to ensure that reserve banks apply a transparent and consistent set of factors when reviewing requests for accounts and access to services. The guidelines establish 6 principles that the reserve banks will use and include a 3-tiered framework for the level of due diligence and scrutiny that the reserve banks will apply. I'll briefly touch on the 6 principles with focus primarily on legal eligibility. The first principle: each institution requesting an account or service must be eligible by law in the US under the Federal Reserve Act or other federal statute to maintain an account at a reserve bank and receive Federal Reserve services. In addition, which I'd like to emphasize, they should have a well-founded, clear, transparent, and enforceable legal basis for its operations. What this means is that the well-founded, clear, transparent, and enforceable legal basis looks to private law. It assesses the consistency of the institution's activities with respect to applicable laws and regulations, such as laws and regulations regarding funds transfer and other laws regarding security interest. And as many of you know, the law with respect to crypto assets is underdeveloped in this area. The guidelines clarify that legal eligibility does not bestow a right to obtain accounts and services, but that determination is at the discretion of the reserve bank. The other principles I'll touch on, just mentioned very quickly, are the risk to the reserve banks, the risk to the payment system, the risk to the financial system, the risk to the economy, and risk to monetary policy. The 3-tiered framework, largely in a nutshell, ranks the institutions, places the institutions in tiers from lowest risk to highest risk, with the lowest risk being those that have federal deposit insurance, and those with the highest risk being in tier 3 is those institutions that neither have deposit insurance nor are they supervised by a federal regulator. That concludes my prepared comments, and I'll turn it back to the panel and the moderator. Thank you.
Thanks very much, Avery. We've got some time to open the panel up to some questions, comments, discussion from the floor. We welcome anybody out there who has a question or comment to join in. I have one or two of my own, but I'm happy to defer those until everyone's gotten their questions out of their systems. Hamza?
Thank you very much for the excellent presentations. I thought they were incredibly thoughtful and interesting. In particular, I found the last presentation to be very insightful, given Unidois' work in the area of digital assets and private law as well. In particular, listening to the first part of your intervention focused on the Basel Banking Committee's regulation or papers on how much exposure banks should have on what types of digital assets. I thought that was incredibly interesting. I was wondering, particularly with regard to the group 1 type assets, which for us, we describe them as linked assets. And generally, we tend not to touch how that link is built. But if I understand it correctly, the Basel Banking Committee provides extensive guidelines on how a link between an on-chain asset and an off-chain asset, such as a bond or a security, should be built. Could you perhaps talk a little more about how you ensure that link exists, or what the types of rules should be in different jurisdictions for that link? Because at Unidois, we chose not to touch that because we understood that's something that jurisdictions might treat very differently depending upon their own domestic rules and procedures. And then I think the second part of my question is, for this consultation paper that they launched, the amount of exposure they sort of permit to these group 2 assets is incredibly low and has received a lot of criticism from the crypto industry. I was wondering if you had any thoughts on that. Thanks.
Giuliano, Avery?
Yeah, maybe I'll let Giuliano start and I can add in. Thank you.
Okay.
Okay, I was thinking the opposite, but I'm happy to go ahead. So thank you for the point. There is a bit of a catch-22 here, because the idea that certain, for instance, the linkage, as you were saying, that is going to be defined at the national level. I'm talking from a law reform perspective, and I will let Avery actually comment more on the ecosystem that generates. But from a law reform perspective, that linkage is pretty much what is, as you define it, a linked asset, is pretty much everything that matters. So in a sense that the different ways in which there is or there isn't some connection to some other assets, and so we're talking about natively digital token or non-natively digital token, is actually, it changes dramatically the regulatory treatment. So by, let's say, staying away, which I understand the reasoning in like leaving to the national domestic authority to actually define, we might end up not knowing what we are regulating and what we are really talking about. Because if, for instance, there are some deposits attached, or if there are some bank accounts attached, well, actually, that changes the entire story of the plan, because actually will render, it will trigger a number of regulatory definitions that are akin to banking regulation that might even consider the assets more attached to it. If we're looking at, for instance, stable coins, or we're looking at a central bank digital currencies, well, we might do see that there is a linkage to some bank reserves or to some central bank money or to something else. And so but the nature of this linkage and the type of asset is linked to changes dramatically what is the regulatory qualification. And therefore it changes, it has a number of other, let's say, consequences. So it is a smart, let's say, a move for sure, and I'm sure it's been taught profusely, not to step into that area, but there might be a risk on the other hand, and I'm saying I'm just flagging it, that when it is implemented, we don't know actually what to implement, and we don't know exactly what kind of linkage we're really talking about, and whether, for instance, banking law should trump over the principle on private law for digital assets, because actually is qualified under given digital assets enters into the perimeter of banking regulation. I stop here, but maybe Avery can actually comment even further. Thank you.
Thank you, Giuliano.
Thank you. Thank you, Giuliano. And thank you for the question. I will be very brief here. I think those are both very good questions. I would just remind folks that the principles are proposed. I think the second consultative document, the comment period closed just recently, September 30th. And with respect to how legal rights are determined for that linkage, the proposed guidelines are very general currently and don't say anything more with regards to that. So, I don't think it's intended to be prescriptive in what form of, with regards to private law and how that can be achieved. But I think there's probably a lot still to be determined on meeting that standard.
Thank you so much. Jay?
Just going back to the question that was raised during the previous session, on the IP, it is covered by the model law on secure transactions, and security interests in IP are covered under the model law. We do not address the protection of IPs under the model law itself. I know that we focused mostly on prudential regulations, mostly with regard to digital assets, and the panelists have done that. But my question is actually, because we're talking about the regulatory field and the regulatory sphere, there's been a lot of emphasis recently about sustainable financing and green financing. And I was wondering whether the panelist has any views on how that kind of a regulatory framework where the sustainable financing is being emphasized and possibly imposed on the banks could have an impact on the access to credit for MSMEs that we're trying to actually achieve by having a secure transactions regime. So I think this is something that might be coming in the way of the regulatory sphere. And I was wondering whether the three speakers have any thoughts on that. And just going back to what Mike Dennis has mentioned, if you look at the doing business indicator on getting credit, which is being revised as a financial services indicator, there's going to be an element of some standards on sustainable financing and green financing involved. So I was wondering whether that actually would be something that we need to think about.
Thank you, Jay. And I wonder if I could just add a little bit as well to your question on sustainability and in financing. I think we're seeing an unsiloing of areas like secured transactions and procurement and investment more generally, and much more of a notion that the leg bone is connected to the hip bone kind of thing, where it's all relevant to food security, infrastructure, manufacturing, and trade. And it all boils down to investment, and then investment, of course, down to secured transactions and these new buzzwords of environmental and social governance and sustainability and resilience and green growth and green finance. And where do you see regulatory agencies fitting into these new paradigms and regulation, I guess, in general? What do you see happening at the regulatory level?
Well, let me provide just a very general perspective, and I'll defer to the experts, the regulatory experts on the panel. But Jay, I'm quite happy to hear your question, because that clearly illustrates you thinking beyond the limitations that we faced in 2017, when Avery, Giuliano, and I sat at the 50th Congress of Antitrial and advocating for your organization to actually look into some regulatory issues. And as you know, the 2019 practice guide does cover some regulatory issues. And then we took it a step further. Unidroit, Giuliano drafted a nice piece of commentary for the guide to enactment for the factoring model law. And we will have a similar piece on warehouse receipts covering different aspects. So we can see the progression from 2017 to today. So basically what you are asking about is a question for maybe 2021, as we have been careful thus far in terms of addressing regulation. And as you have seen yourself, there still has been some pushback from institutions, including yours and UNIDROIT, as to how much into regulation the instruments and the guides should venture. So I don't have any specific answer to your question concerning green finance. Obviously, it's more for Avery and Giuliano to address, but I'm happy to hear where the trajectory is leading us, which obviously will require more coordination with the relevant regulatory agencies, as we can't just invent some regulation that we believe will sustain secure transactions and related finance products.
Thanks. Avery and Giuliano?
Sure, it's a good question, Jay. And I'll just say, you may be aware that there's an organization of central bankers, I believe, called Greening the Financial System, which central banks are participating in dialogue and discussion and development around ESG. With respect to the U.S., so it's largely dependent upon the authorities of the regulatory bodies in each jurisdiction. And the U.S., the current approach is it's something the federal bank regulators, including the Federal Reserve, are keeping abreast of and monitoring, primarily by understanding and engaging with institutions in the United States that have voluntarily determined to implement measures around ESG.
Thank you. Giuliano, do you have something you'd like to add?
Yeah, very quickly. Again, exactly. I think if I may be a bit also direct, since we've been involved in this work of regulation and coordination with Marek, Avery, and of course with UNIDROIT, UNCITRAL since 2016. I guess that actually green finance, maybe even digital assets, but is where we know what is going to happen if we do not coordinate. So any form of regulatory incentives or regulatory activity that is going to affect finance in general and the world in general cannot be not considered by whoever is developing products that wants to promote access to credit. So this was the same thing with prudential regulation. We learned the lesson and we did it. This is going to happen with digital assets, and it's going to happen with green finance. So we know pretty much now how's the plot, and we can choose, to engage, to even have like some sort of coordination where we can provide, when UNIDROIT, UNCITRAL can also provide for a solid private law basis that can help regulators, which, as we were saying before, do not have a private law basis. So it's going to happen. It's up to us if we want to coordinate or not. But in any case, there is, as Marek was saying, also, it's not up to us, but it's more about to coordinate, to define the standard, but more to coordinate.
Thank you very much, Giuliano. I have one more quick question. I'm curious. 10 years ago, speaking of regulation and regulatory formation, 10 years ago, a lot of development work was around deregulation or regulatory guillotining, and I think the tide has turned in the direction of smart regulation as opposed to just simple deregulation or getting rid of regulations. And I'm wondering if you are seeing the same thing, particularly Marek and Giuliano, if you're seeing some of the same things in your work.
No, for me, it's actually the other way around.
No.
The only form of regulation that I came across 12 years ago was that the central bank would run the collateral registry and they would try to extract some data, which we thought shouldn't be extracted from the collateral registry because there wasn't the function, but we basically left it there and we hoped for the law to stimulate credit. And then over the years, as we heard from the previous panels, the stakeholders realized, well, something is not functioning. So let us look deeper into what is not functioning very well. And it was basically this lack of regulation. We were not tasked one way or another to regulate more or deregulate. It was more an ignorance of regulation. But with these examples, particularly in factoring, we see that there is more emphasis on regulation, making sure that licensing is appropriately provided for in these statutes and related regulations, so that the parties to a transaction are confident that the deal will be enforced as it is. So that has been all my experience.
Thanks. Giuliano or Avery, do you have anything you'd like to add to that?
Maybe, yeah, I'll take this very quickly. Yes, thank you for, and I'm adding to what actually Mark just said. Like, okay, again, I give you an example. In the past years, I would say some of the most pressing, urgent requests, as some of, as the IFC and EBRD knows very well, is actually to go into a given jurisdiction and verify whether specific credit products can work given the existing legal and regulatory environment. So this is exactly the difference from the bottom-up or the top-down approach. So in this process, of course, there are certain legal elements that are essential for certain products. For some product, registry is essential, but for others not. In all these products, however, the regulatory treatment is essential, no matter what jurisdiction. And is essential simply for the reason we were saying before, that the industry of a given market needs to know whether a given product is regulated or not. And sometimes, if it is regulated, there are some benefits. There are also some hurdles. So the process is exactly in the other way around. And that's how we came across, and we really see firsthand how, coordination is important. And again, sorry, I conclude, regulation doesn't have to be seen as an obstacle. And Marek was saying, is ignorance. Sometimes we don't understand there are two words, but actually it can be an asset, to pun unintended, to promote certain kind of legal reforms, broader legal reforms. Thank you.
Thank you. I think we have time for one or two more very quick questions. Yes, please go ahead.
If you don't mind,
sorry.
I'm so sorry, Avery, did you have something you wanted to add?
if there's time, but I don't want to cut off a question. I would just add that to the question about change, I think the pace or the lack of immediate change in the crypto space, for example, from the prudential regulators, is an indication of the intent to be very thoughtful in adopting regulation in a space that is changing very rapidly, and trying to get the balance right and hear from the participants and stakeholders about this before implementing regulation that could run the risk of stymieing development and technology. And so I would say regulators still focus on principle-based regulations and being very thoughtful and deliberate in doing so.
Thank you. Thank you very much. Now you can go ahead with your quick question.
I don't know if it's leaving Avery. Congrats to all the panel. Very interesting. I have two questions. First, for Avery, I don't know if it's still there. You mentioned a different risk. I would like to ask you about the CBDC and the risk of centralization. What do you think about? And the second question is for all the panel about, again, the CBDC, the central bank digital currencies. What do you think about the Chinese social credit and the risk with the CBDC?
Yeah, that's a very good question. And I would respectfully mention it. I probably have no comment on that. I know a lot of folks at the Fed have been working on CBDC, and there's a lot of public statements about what the Fed has been doing to make that assessment. But I'm really not in a position to comment on that. I'm sorry.
Now, as to your question on the CBDC, there are several dimensions that need to be examined. One is whether that makes sense from the monetary policy. We're not equipped to guide you on that. And there's this regulatory piece that the IMF works with central banks on both of those aspects. And there's the privacy of information piece, which again is sort of outside of our area of expertise. What we are experts on is the private law of transfers of CBDC and the rights that people acquire that should be equivalent to those that people acquire when they take cash or transfers to bank accounts. So this is within the scope of the project at Unidra on digital assets to provide a confidence to transferees that they get equivalent rights and protections as transferees of money, as we colloquially refer to them. But these other pieces, those are not really either private law or they more belong to the jurisdiction of some other agencies.
Okay, thank you, everybody. Thank you so much to the panel. And with that, I'll hand it back over to our gracious host.
So I'll ask each of you to provide your final remarks, and I'll just close the event. So following the order that we had before, Councillor has the floor.
Thank you. I'll make it short. I think we kind of exemplified why we need regular meetings between the different organizations, because we need to have updates from the different organizations and also from the other relevant stakeholders on what's going on. And I think that's what we've been able to achieve in the last 1.5 days. And we look forward to cooperating with the other agencies more closely. Thank you.
Thank you very much. Elaine, World Bank, IFC.
Yes, thanks, Ignacio. Well, first of all, I mean, I would like to thank, our host delegation here, Mr. 12, for putting together a fabulous 2 days for us. So thank you very much for all the hospitality and, all the facility. I mean, it's pretty incredible to be working in this kind of place. And obviously to my partners in this kind of an event. So just a quick summary, I have nothing really to add. I think it was fantastic. I think absolutely the discussions that were had today really illustrate the point on the need for coordination at a number of different levels. So I think we accomplished that objective out of this 2-day session. I just do want to say that it was originally agreed that we would sort of share the role of chairperson when we're conducting these things. So next year, I'm welcoming you all to Washington, D.C. And the World Bank Group would be happy to host you there and see what we can do. I'm not sure we can match this, but we'll give it a go. But let me just leave it there. And thanks again to Ignacio and to your team, Will, Michelle, the whole group. I know there's a lot that goes into this behind the scenes, so very grateful for all of that.
Elaine, so Washington, D.C. it is for next year. Now AES actually happens to be in Washington, D.C. too.
Yes, thank you very much. I will just reiterate what the others have said. Thank you so much to our host and your team. And thank you to the other partners who are part of this network, the OAS. We're very pleased to be a part of this network for coordination. And I think what was illustrated again from these 2 days of discussions and then the panel that I was privileged to moderate was the need for the capacity building on different levels. So that was really, I think, a point that came out in this conference, which maybe wasn't brought out so much in previous ones. So I think that is very illustrative. So with that, I will turn the floor back to you. Thank you again.
Thank you, Jeanette. This has been very, very quick. Okay, National Law Center. Yes.
Thank you very much, Ignacio. I'd like to add simply my thanks to those that my colleagues here at the panel mentioned, to the Secretary General of UNIDRA and the UNIDRA Secretariat, to all the member organizations, and to all of you. I learned a lot of things. Of course, that coordination is important, and we should go on with it. And that it takes, I thought that it takes 2 to tango. Here we learned that it takes more than 2 to tango. And that's important because, for example, with regulatory authorities, at least if we are the one side, they are the other side, they have to be willing to tango. Otherwise, we are just informing ourselves and our groups, which is fine, but we don't get any reaction from that side. So with that, I would again thank you all and congratulate UNIDRA for hosting such a wonderful conference and being such a nice host. One of the nice things of UNIDRA is this beautiful building and the hospitality of UNIDRA. Thank you.
Thanks a lot, speakers. Jay.
I forgot to mention, because my colleague Monica Kanafkulia is on the screen. There is still ongoing work, legislative work that's going on in the UNIDRA as well as in UNSTRA. We have our access to credit working group that's meeting next year, hopefully providing the final product to the Commission in the summer. So I would ask all of you to keep abreast of what's happening at UNSTRA and have an interest in what's going on and access to credit at UNSTRA. Thank you.
That was unnecessary. We always keep. Right. So I will take a couple of minutes, a little bit more on the merits of the discussion. I think you all has been 2 very, very good days of discussion. I really think we've taken the project 1 step further, which is the objective of each year. We, I think, have come to an agreement that, following up on what Peter said in a way with the Argentinian dance metaphor, apart from the usual suspects and those that do directly either create standards or implement those standards, there is a need for many other organizations who do related work to be involved in this project. And in light of this, and following the discussions and the meeting that we had of the executive committee on the first day, we will be sending out invitations for membership to formally to the relevant organizations. I mean, expect them before the end of the year, but we will be as quick as possible. But since we will not be meeting for a few months, so you can go back to your headquarters and say you will be receiving a letter too. So prepare for it, but it won't happen next week. Second, there seemed to be a clear consensus that at least an important part of this network has to be based on stable platform, which will be a website, if you will, or whatever you want to call it. But that is not just that we will be having to discuss many issues as to what the content should be, how to handle it. And so we have fixed that at least that should be what we will be heading for and moving towards. But there's a lot of discussion to be had still on many aspects of it. And we will be providing a summary, hopefully with the help of all the chairs of all the panels on the discussion. But the discussion of panel 1 today, panel 3 in the conference, which was more targeted at the content of these, will be much more detailed, more like an outline of all the items all the ideas that arose, and on the basis of those, it will be that we will be shaping the future instrument that actually materializes in the near future. So having said that, it only remains for me to thank my wonderful team. And I'd like to start by mentioning Will Brady Watson, or in Italian, Brady Watson, Michelle, Audrey, Valentina, Daniele, Stefano, Laura, Nicoletta, Hamza, Katerina, and everyone that has been so helpful during these days. And apologies for the technical problems.